Hello, welcome European listeners and market participants, and welcome to KBRA's latest European Credit podcast, Conversations in European Credit. I'm Gordon Kerr, Head of European Research at KBRA, and today I'm joined by my colleagues, Asha Drobnik and Patricia Cantwell from our European Financial Institutions Ratings team. In this episode, we'll be covering the topic of the growth in private credit in Europe. We've outlined this in greater detail in a report on our website, or you can check it out on our social media posts. Across Europe, private credit has seen marked growth since the global financial crisis as providers have expanded significantly across the European lending market. Europe has typically been a bank-dominated market, but they have shifted their focus towards lending to typically larger investment-grade corporates as a result of more stringent regulatory requirements and balance sheet pressures. Private credit managers have taken advantage of this opportunity over the recent years as demand for lending has increased in combination with a healthy mergers and acquisitions market. Further to this, recently there has been a large increase in committed but unallocated private equity capital, typically referred to as dry powder, and this has supported the growth in private credit, and most managers appear well prepared for the challenges ahead. Now, let's dig into the details. Patricia, welcome.
Thanks, Gordon.
Now, tell us a little bit more about the long-term growth prospects for European private credit.
Yes. According to Preqin, global private asset under management, that's AUM, totaled over $1.3 trillion and is expected to almost double by 2027. North America accounted for 2/3 of total AUM, while Europe 1/3. So there's plenty of capacity for Europe to expand in the private credit space. Even in the more developed European markets, private credit accounts for just 2/3 of the financing from European mid-market buyouts. And this compares to around 90% in the US. The UK, France, and Germany account for around 70% of European private debt right now, but represent a significant lower proportion of total European GDP. So this allows for potential outsized growth in other European countries.
Thank you, Trish. Now, Asha, how does the performance of private debt managers compare to those of the public markets?
Thanks, Gordon, and thank you for inviting me here. Many asset managers have successfully grown their private credit platforms in Europe and provided attractive and consistent risk-adjusted returns to their investors. These well-established and large managers have raised and deployed multiple funds. To date, they have delivered strong performance with relative stability, but they will be tested in this more challenging economic environment with rising interest rates and inflationary pressures. Saying this, private credit capital is less volatile, and this is a big positive and a mitigant at the same time. This means that private managers can offer an attractive alternative to investors compared to the public markets. They can take advantage of improvements in risk-based pricing and terms, while public markets remain inhospitable and European bank lending capacity is limited. In addition, private debt managers have built up strong relationships with PE funds looking for debt funding for European buyouts and with corporates looking to fund M&As. Private debt funded transactions now represent most of the European financing in the mid-market, with a rise of large transactions and club deals as an alternative to capital market solutions.
Trish, can you expand on this as to why really private equity firms are choosing private credit as their source of funding?
Yeah, sure. Many European PE firms are choosing private credit funds over traditional bank financing because they can offer bespoke loans and a greater speed of deal execution. Here are a few benefits. Private credit has access to high-quality counterparties. Any sensitive financial information can be limited to a tighter circle of creditors, which provides a competitive advantage over traditional banks. Private credit funds can offer follow-on capital, for example, committed acquisition facilities to support a company's buy and build strategy. From a company's perspective, buy and build strategies need financing partners who can act quickly with a commercial mindset, in addition to being flexible in terms of the debt quantum involved. And according to PitchBook, European take-private transactions could reach 30 billion by 2023.
Thanks for that, Trish. Now, how has the private credit performed over the past year in a challenging environment?
Yeah, private credit has shown more resilience over the past year. Unsurprisingly, during 2022, leveraged loan and high-yield bond issuance fell in Europe and the US due to more challenging markets. That is, higher inflation, higher interest rates, tightening monetary policy, supply shortages, and the impact of the Russia-Ukraine war. For example, according to DebtWire, in Western and Southern Europe, leveraged loan and high-yield bond issuance fell 37% and 65% respectively. And similar can be said for the US. At the same time, European direct lending issuance grew to 52 billion in the first 9 months of 2022, well ahead of 2021, according to DebtWire. In addition, the spread between the yield on leveraged loans, high-yield bonds and private credit has also narrowed significantly since 2021. Investors in private credit funds are sharper and more selective in their asset choices and prefer the larger, established funds over their newer rivals.
Thank you, Trish. Now, how has the economic environment created opportunities for these private credit managers in Europe? Asha?
So European private credit managers have taken advantage of current market environment and gained market share. As Trish mentioned, there has been noticeable reduction in leveraged loans and high-yield debt markets, and banks have decreased their risk appetite. This resulted in higher deal flow to private credit funds. Corporates have been choosing private loans over issuing more expensive corporate debt, as interest rate pricing in the liquid market has increased to a greater extent. As take-and-hold lenders, private credit funds have provided greater certainty for borrowers in volatile credit markets. When the syndicated loan and higher yield markets recover, they might take back some market share from private credit funds. But in our view, the latter will likely gain market share over the long term.
Now, this growth does not necessarily come without its challenges, especially in the current environment. How do the private credit managers face these ahead, Asha?
So we have more difficult macro environment with rising interest rates, slowing global economy, inflation, and weaker private company valuations. Adding to this is more recent shockwave across banking sector following the collapse of Silicon Valley Bank in the US. So it is likely that this macro environment will challenge middle market borrowers and lenders, which could result in higher default rates. To give you an example, in previous research published by KBRA, we calculated that an additional 16% of companies paying an all-in yield of 12% might not generate enough operating cash flow to cover interest expenses. That said, KBRA has identified several factors that support private credit industry's ability to better absorb and disperse the impact of higher default rates than traditional lenders. These characteristics include typically highly diversified platforms, lower susceptibility to dramatic swings in valuations, relative to banks' limited exposure to corrosive impact of capital charges and forced liquidations, and mutually beneficial collaboration among sponsors and lenders. We believe these characteristics support the wider private credit industry, which presents less systemic risk during the cycle than others might fear. Although smaller and weakened platforms are likely to suffer greater losses. Overall, direct lending funds are better positioned to lend with their abundance of dry powder, combined with an ability to execute transactions quickly, as well as their long-term approach to borrower relationships. KBRA expects to see continued private credit market share gains in this environment, in particular for the bigger private lenders.
Thank you very much both for your engaging insights. So in summary, the market for direct lenders in Europe is likely to continue to grow. Banks have left a gap as they have withdrawn from the sections of the lending due to regulatory burdens and different approach than the private credit market. The current incidents in the US are likely to only increase the regulatory restrictions on the banking sector. Direct lending funds are well positioned to lend with their abundance of dry powder combined with an ability to execute transactions quickly. Private equity is also significant dry powder, which is an excellent source for deal flow to private credit, a potential mitigant if existing transactions need to be restructured in a more challenging environment. Both also offer a long-term relationship with a single borrower or small borrower group to help work through any issues should they arise. Private credit industry is generally positioned to navigate the looming storm. There are several factors that provide the necessary ingredients for the private credit industry to be patient capital that can better absorb and disperse the impact of higher default rates than traditional lenders, as outlined by Asha and Patricia. Thank you both again. Please make sure you are registered on our website, kbra.com, and have subscribed to our podcast to be sure you don't miss out on our latest research. Of course, also make sure you are engaged with our experienced analysts. Thank you again very much for listening. We look forward to bringing you more conversations in European credit. Stay strong out there as we all navigate towards a better environment.